First of all, I would like to say thank you very much for this invitation to the Brazil Center for International Relations, with whom we have a very good relationship. Just to put you in the picture, what we do and what I do particularly at the South African Institute of International Affairs, we have a China and Africa research project where we concentrate on all aspects of China's investment and trade with Africa. We have individual country studies that we've published. We've had political overviews on the political implications. We also look at individual sectors, and the ones we concentrate on now in particular are agriculture and banking. Now, banking and financial institutions is what I'm going to talk about today, and particularly what the impact has been. I would start off by saying that it's important to keep in mind that China's involvement in Africa and China's banking involvement in Africa is predominantly driven by two factors. The first is the thirst for resources, and the second one is what happens both in China with its banking sector. And I hasten to add a third very important factor, which we didn't foresee at the time when we started this research, and that was the global financial crisis. Now, the impact of that on China has been particularly good, very fortunate. For others, it's been much less fortunate, including myself. I worked for Lehman Brothers for 5 years. I'm left with a whole lot of stock, and I intend to sell the stock certificates on eBay. Maybe I'll get 1 cent on the dollar. Just to roll on to the first slide, which is this one. I'll put it in context and look at the content and the character. I won't stick to the presentation very closely because much of what is in there you've already heard. It's very much driven by resources, as I said. The investment by China in Africa at the moment is pretty much focused on oil resources. Victor has already mentioned the companies that are there. The one that I would just hasten to add is probably ZTE, which is the major telecoms infrastructure company of China that is establishing a very big presence throughout Africa, including South Africa. The exposure of China to the world is changing. It's got a much greater stake now in maintaining global responsibility and stability in the financial system. This started in '97 with the Asian crisis, when China served as a rock of stability, when other countries faltered all around it. It was the same during the financial crisis in 2008. So from that perspective, it's actually got a very exemplary record. There are, of course, greater demands for China to now share the responsibility of the international sector. If you're an international power and a superpower, with it comes a lot of opportunity, and it's sometimes a little difficult for China to adapt to this new role. Just to indicate how quickly trade has jumped, a tenfold increase from 1997 to 2007, the significant growth in FDI, and particularly the important role of China Exim Bank, which Hannah has alluded to already. Now, this is pretty much just to show where the activity is. The imports from Africa into China is pretty much just dominated by resources, and particularly oil. Now, this is not insignificant. It is a very good opportunity for banking in certain areas, and we expect this to change little going forward. The problem that China faces, of course, is that a lot of these resources are predominantly based in countries where there is a history of political instability and conflict zones. And from an extraction point of view, that's easily solved by Chinese government intervention, the type of deals that they're doing. But from a banking perspective, that's a little bit more problematic. But I will show in a moment how China gets past that. Africa's interest in China is significant. Of course, it provides an alternative to the usual suspects in the West, old colonial powers that demand accountability, democracy, all these things in exchange for trade, which has got a very patchy record. China insists on none of that. as we've heard already, the no strings attached policy. And then, of course, there's also the regime stability in China. There's no chance of the Communist Party being kicked out anytime soon, so there is at least policy predictability for Africa. Now, China offers Africa a great incentive. It has grants, it's got cheap loans, it's got government backing. It has even cancelled a lot of the debt, and this was prior to 2006 when we really started concentrating on China-Africa relations, but it's actually preceded that by quite some time. It also does a lot of, as we've seen in Angola in particular, as the prime example of infrastructure for commodities, where China puts an infrastructure in exchange for commodities. That's been the running model. It is not very different. It's nothing new. It's not what is different from the colonial model in previous eras, where the British or the Portuguese or the French would put up infrastructure and get the commodities out of it. So on the face of it, it's very much based on that colonial model. Now, having looked at what drives its investment in Africa, one also has to understand the macroeconomic conditions in China. And it's a particular problem that China has, and that is that it's got too much money. With so much money flooding the country, coming in, and with such a vast deposit base, I'll just show this. Capital formation in China is now almost not driven by FDI at all. It's all about domestic savings, both households as well as corporations, retained profits. The banks sit on enormous deposits. It also has to buy up a lot of government paper so that the central bank, the People's Bank of China, can sterilize the influx of foreign money. Again, I've just shown then the growth in terms of capital formation by source over the last couple of years. The banking reform I can skip. That was in the 90s, and it's just an overview of the banking sector and how it's come about. What I would like to concentrate on this particular slide, which is from the Financial Times and just compares bank sizes in 2000 and at the end of 2009. From that you can see by market cap that the Chinese banks dominate. ICBC is of course the biggest bank in the world. If you look at the stock prices, the price to book ratio, which tells you how expensive a stock is, it is very expensive, but that probably indicates to us that investors have a very bullish view of Chinese banks and their ability to generate extra revenue going forward. Now, given that we've got this particular problem, Chinese banks have massive investment assets or liabilities in the form of deposits. What do they do with the money? Well, you know, up until now it's been domestic lending, but there's a crisis or a potential crisis looming in China, a credit bubble. The government has implemented all kinds of new regulations to ease the growth of credit, which will force the banks pretty much to look outside of China and elsewhere to generate new returns on their investment. This probably will mean for Africa that the banks will look at it anew and probably with a new, more stronger interest on the growth of its investment in Africa. We believe that the Chinese banks have a particular advantage over Western banks, and this is the involvement of the Chinese corporate sector in Africa already.